afternoon, and good evening, wherever in the world you are. Welcome to the third episode of Palmetto Property Talk. And today we're going to be talking about what is a mortgage. This is going to be a multi-part series, so there's a lot that we're going to have to talk about. But we're going to cover a little bit of the basics today. So, Walker, what do you have to say?
Mortgages are fun. Everybody loves looking at numbers and talking about financial issues.
Yes, I think it's a riveting topic, but that's why we're here. So
make it a little more digestible. Break it up a little bit.
For sure. Well, all right, guys. Boom. So fun stuff. We're going to talk about a few of these topics. These are just four of the big terms that are out there. So a mortgage payment is just like any loan. So with a loan, you have a principal, which is going to be the amount that gets paid to the, well, it depends on if you're talking about a payment or if you're talking about the entire principal for the loan. So I'll give you a quick example. So I have $1,000 loan, okay? The principal is $1,000. So when I make a payment, let's say the interest rate is 3%, I'm making a payment that is 3% amortized. Let's say it's a 1-year loan. So 1 month, I'm paying 3% interest on that $1,000 balance. So interest goes towards, or part of the payment goes towards the interest, and part of it goes towards the principal, or the entire principal for the loan. All right, as it says, the amount borrowed to buy the home. Then just to make sure we're in line, the interest is the cost of borrowing the principal expressed as a percentage. So that's why you talk about mortgage rates. So 5%, that would be nice, but more so like 6.5% right now. That's what interest is. Then we talk about escrow, which is the account where a portion of your monthly payments is held in order to pay property taxes, insurance, and in some cases, homeowners association dues. So I would say the big thing with that, when we talk about this is talking about your monthly payment, right? And then you also have the one fun thing that most people have on their house and for their mortgage is a PMI payment, private mortgage insurance. We're going to talk about some options of how to avoid private mortgage insurance and also explain what I was talking about with principal, interest, escrow, and all of these other fun things with some examples. So Walker,
For those who don't know, what is private mortgage insurance? What's the purpose of it? And why do I need to have this on my loan?
Yeah, so private mortgage insurance is put in place. You can either, the client can have it put in place when they apply for the loan, or a lender can put private mortgage insurance, a lot more expensive. But the reason why that is on there is if you have below 80% equity, so if you have, or not 80% equity, if you have not put down 20% or more down payment on the house, right, it's looked at as a risk. So to avoid what happened in 2008 and during that financial crisis, they've put private mortgage insurance in order for buyers to be able to buy a house with as little as 3% down.
Right.
So it's more so a coverage for the loan, but also a coverage for the buyer.
Right.
So yeah, it's not everybody likes to do it, but at the end of the day, that's what happened in 2008.
Right.
Even though private mortgage insurance has been around longer than that, it is something that has helped prevent more catastrophes from happening.
People defaulting, not being able to afford their loans.
Exactly.
Those subprime mortgages, that little buzzword.
Well, you can still do subprime mortgages. It just depends on what you're talking about. If we're talking about predatory lending too, there are subprime mortgages. They may require a very expensive PMI payment, so they do exist still. So, yeah.
Fun stuff.
Yeah, private mortgage insurance has been around since the 70s, I believe. The first, I'm trying to remember, it was either an act or it was, there's a few that I worked with when I worked at a bank, and they're really great companies. They do look out for the client, but because they allow you to be able to buy a house with as little as 3% down which is crazy because if you're buying a house that's worth $400,000, you're only putting $12,000 down.